Hey guys, Rafi here from the Endgame Investor. Things are happening fast and furious now, so I want to get through what the Fed just did. Is it a bailout? Is it not a bailout? Well, we're not going to use any controversial words like that. I'm just going to show you what they are doing in their own words and then explain with a little pyramid. And then we're going to get into what is happening with Silicon Valley Bank, which just got bought for $1.
$1!
Kevin says $1. Kevin says $1. I've never seen a happier $1 bid. You're so confident. You're so sure. Kevin just knows it's $1. You see the way he bid that? $1. I got this. Don't worry about it.
Here, $1.
By HSBC. Basically, what the Fed is doing is taking all the losses of the banks, the commercial banks and the local banks and whatever banks that need money because the bonds in their balance sheet have collapsed in value. They're offering to give them the full face value of the bond at maturity with no limits. And so what happens is that the losses that are on the bank balance sheets will be transferred to the Federal Reserve itself, which already has considerable losses of about 1.125 trillion in unrealized losses, the same kinds of unrealized losses that pushed Silicon Valley Bank under. There are other banks that are in SVB's situation where they have a run on deposits because their clients don't have any more income because interest rates are rising. So they have to sell bonds on the market to raise the money to give the depositors their money so they can pay their bills. So what the Fed did is instead say, well, you don't have to sell those bonds at the market now. You can just sell them to us at full face value at maturity, and we'll give you the full value, the value you would have gotten had you held it to maturity. You can use that money to pay off your depositors, and we'll be stuck with the bill with the losses. And if the Federal Reserve is stuck with the losses, that basically means the dollar itself is stuck with the losses because the dollar is the liability unit of the Federal Reserve. So who is bailing out these banks? The dollar itself, and therefore anyone who uses the dollar. So yes, this is inflation, and we're going to watch what happens to the Fed's balance sheet numbers and the money supply after this starts to roll. Anyway, let's get to the pictures. So here is the press release from the Fed, March 12, 2023. It says, Federal Reserve Board announces it will make available additional funding to eligible depository institutions to help assure banks have the ability to meet the needs of all their depositors. They're so generous. It's beautiful. All this giving American nature, it's a wonderful thing. And so the solution is they've come up with a new alphabet soup, another fund with a bunch of letters in it that will end up giving banks a bunch of base money. And we'll show you what that is in a second. So this paragraph is key here. The additional funding will be made available through the creation of a new bank term funding program, offering loans of up to 1 year in length to banks, savings associations, credit unions, and other eligible depository institutions pledging U.S. Treasuries, agency debt, and mortgage-backed securities and other qualifying assets as collateral. This is the collateral that Silicon Valley Bank had to sell all at once in an emergency to meet the depository requirements of its depositors. So these assets will be valued at par. That is the key. What is par? Par is the value of the bond at maturity. Now, this is how bonds work. Let's say the government wants to borrow money from you, and it says it will pay you the face value of a bond. Let's say the bond is $100, and you will pay money for that bond to get that $100 at the end of the term. Let's say it's a 1-year bond, and you pay $90. So then the interest rate on that bond is like, let's say 10%, whatever the math is, $10 out of 90, 9%, whatever. The interest rate is basically the difference between what you pay for the bond and what you get at maturity. So the value of the bonds in the market now is the value that people will pay for them and get the interest between what they will pay for them and the value of the bond at maturity. So the Fed is promising whatever paper you have on your balance sheet, if you need money to pay your depositors, we will pay the full maturity value of that bond, regardless of what the interest rate is. Give you that money, you pay your depositors. The bond goes on our balance sheet. We get the loss because we paid the par value at maturity and we're getting only the market value now. So that loss is immediately added to the Federal Reserve's balance sheet. Let's continue. Here's the key sentence I'm highlighting here. The BTFP. Isn't that like a BTFD by the FDIP? Close, you know. BTFP will be an additional source of liquidity against high quality securities, eliminating an institution's need to quickly sell those securities in times of stress. So basically in times of stress, instead of selling the securities at market, they will just hand them to the Fed, will pay them face value, take those losses on its balance sheet, and away we go. Now, what is this visually? What is happening here? I'll show you on a graph. This is John Exter's inverted pyramid. If you're among this crowd of gold and silver bugs, then you will be familiar with this pyramid more or less. So you have gold on the bottom, which is the most hard money. On top of that, you have base money. That's the money that the Fed hands out directly to banks or whoever that is buying stuff from the government. That's base money. On top of that, you got bank money. Bank money right now, it's like 50 trillion. These numbers are not accurate because this is from a while ago. So bank money is the deposits that you have in your bank account. When your bank account says you have a balance of 20,000, whatever, that's a balance of bank money. It is not all there because it is invested in the stuff on top of it. Government bonds, 56.7 trillion, whatever the number is now. So what has been happening is that this level of the pyramid, this layer where it says government bonds, that has been shrinking along with this bank money that has been shrinking as people need to pay off their bonds, pay off their loans, whatever it is. So these two sections of the pyramid are shrinking. So base money can only be issued by the Fed itself. So basically the Fed is saying, I'm going to take this base money, I'm going to stick some of it into this layer and kind of weld these two together, make them interchangeable, bank money, government bonds, and fill everything up with base money. Move this stuff up here and up here, mix all the three layers together, sort of weld them into a big iron base. Or really a big paper base because it's going to melt down too. And I'll take all the losses, says the Fed. This is going to blast another hole into the Federal Reserve's balance sheet. How big is that hole? Well, I can give you near exact numbers, give or take a few $100 billion or so. Exact numbers from here. I just wanted to show you this. This is very interesting. If you type in unrealized gains losses category at the Fred website, which is where you get all the kajiggers and the charts from the Federal Reserve Bank of St. Louis. So you type in the 21 series of unrealized gains and losses. These are the options. You have net unrealized gains and losses on available for sale securities. This is the losses that all banks have on these bonds. This is what brought a Silicon Valley Bank under. So this discontinued. Don't want to show you anymore. This net unrealized gains and losses available for sale securities, large domestically chartered commercial banks, discontinued. Don't want to show you it any longer. Discontinued as of 2014. All of this has been discontinued. There is no more chart that is up to date. It was all stopped in 2022. So let's just take a little bit of a peek here. Why do you think they stopped it? Why don't they want to publish this anymore? Why don't they want to give you a chart? Well, this is a little hint. Look at the end here. It's as low as it's ever been, and it's much lower now. How much lower? This is what, $88 billion in all commercial banks losses on their available for sale securities. Well, we have, thank goodness, a little bit of honesty from the Federal Deposit Insurance crap over here. This is a speech given by some schlub. I don't even want to look up his name. He's from the FDIC, but he knows the numbers. This is the current interest rate risk. And he says here in this sentence, the total of these unrealized losses, talking about the same category, including securities that are available for sale or held to maturity, and this is by the end of the year 2022, was about $620 billion at year-end 2022. Well, $620 billion, that's a little bit different from this, which is $88 billion by March 30th, 2022. So apparently you moved from $88 billion loss in available for sale securities to $620 billion in like 9 months. Where are we now? We're even higher because they keep hiking rates, and apparently Powell's going to hike it again, making these losses even worse, but not for the banks, for the Fed itself. Its balance sheet is going to be schmeiced. How much? Well, here we have the Fed's earnings statement as of Q3, the end of September 2022. It's much worse now. We don't have the current quarter. This is losses, unrealized losses on its holdings. It also holds bonds, treasuries, and mortgage-backed securities. Same crap that all these other banks hold. What is its losses as of September 30th, 2022? This is even before the $620 billion that the FDIC cited for the end of 2022, $1.125 trillion. That is, that's a lot of money. And they're taking on all of the losses. They volunteered to take on all of the losses of all the banks that are in the banking system. That's another $620 billion that will eventually land on their balance sheet because they just promised to pay the par value. But how are the banks going to pay this back? Well, they won't be able to because because with what? How are they going to pay it back if their deposits are falling and the money supply is falling? So what happens from here? Well, as the Fed's balance sheet gets destroyed, the value of the dollar itself gets destroyed. Price inflation, consumer price inflation rises higher and higher, and the Fed has to keep raising interest rates in order to combat that inflation, which will only make the inflation worse as it destroys continually the value of its own balance sheet because it's the one that owns all the bonds that it is now raising interest rates on. And as it raises interest rates, the losses that remain on the bank balance sheets get worse and worse, and it gets harder and harder for companies to raise money as interest rates rise, and they have to keep paying their bills and servicing their own debts. So we have the recipe for a continually shrinking money supply with higher interest rates and higher consumer prices. So you have the perfect recipe for a stagflationary explosion and eventual hyperinflation. How fast is eventual? But we're going to have to wait and see. And oh, guess who bought Silicon Valley Bank? HSBC acquires Silicon Valley Bank UK Limited. Strategic acquisition to strengthen HSBC's banking franchise, and has to do with strengthening a banking franchise. It doesn't have to do with an emergency. Well, strengthen its banking franchise with what exactly? HSBC Holding PLC announces that its UK ring-fenced subsidiary, it's ring-fenced. Don't worry, everything's ring-fenced. HSBC UK Bank PLC is acquiring Silicon Valley Bank UK Limited for $1.
$1.
Thank you, Louis.
After you.
Certainly.
£1, whatever. But don't worry, says HSBC. The £1 isn't from taxpayers. So everything is going to be just fine. If you enjoyed this video, consider signing up for a 2-week free trial of the Endgame Investor or buy gold and silver bullion from MilesFranklin. Call 855-GAME-END and mention that you got the referral from the Endgame Investor. You might want to do this before the entire banking system collapses. How much time we have, I do not know, but we're going in the right direction here pretty quickly.